Hey everyone, welcome back to Corporate Decoder. Today, MCY just priced $525 million in new senior notes, and I'm seeing a crucial detail about their borrowing costs. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing tells us a lot about how the company is managing its debt and what that might mean for investors. We are looking at a Form 8K, which is used to announce major corporate events that shareholders should know about. In this case, Mercury General Corporation, ticker symbol MC, is announcing the completion of a significant debt offering. This isn't just pocket change they are raising, it is $525 million. The main event here is the offering of what they call senior notes. Think of these like a loan the company is taking from lots of investors, and they promise to pay it back with interest. These specific notes are for 6.250% interest and are due in 2036. That means investors who bought these notes are essentially lending money to Mercury General for the next 12 years. And they will get back 6.250% interest every year. The company sold these notes for almost their full price, 99.764% of the face value, which is a good sign for them, meaning investors were willing to pay close to the full amount. These notes are backed by something called an indenture. This is a formal contract between the company and a trustee, Wilmington Trust National Association in this case, that lays out all the rules and promises for these notes. Pretty standard stuff for bond offerings. It basically spells out how the company will pay interest when it will pay back the principal. And what happens if the company can't meet its obligations? Let's talk about the money. The interest payments, or coupon as it is often called, are 6.250% per year. This interest is paid out twice a year on June 15th and December 15th. The first payment will be in December of 2026, and the notes will be fully repaid on June 15th, 2036. Now, what happens if things go wrong? The indenture outlines what are called events of default. These are serious situations that could force the company to repay the notes much sooner than planned. There are several triggers. For example, if the company defaults on other debts exceeding $35 million, and that default isn't fixed within 30 days, that could be an event of default for these notes too. Also, if there is an unpaid judgment against the company for over $35 million that isn't on appeal or being contested, that's another trigger. Defaulting on interest payments for the notes themselves, or failing to pay back the principal when it is due, are obviously big problems. Even failing to meet other important covenants in the agreement for 60 days after being notified could lead to default. And of course, any kind of bankruptcy or financial restructuring for the company would trigger default. It's important to note that these thresholds are quite high, particularly the $35 million figure for other debts, suggesting the company has a decent amount of leeway before these events are triggered. This debt offering also required a change to the company's existing credit agreement. They entered into a fourth amendment to their credit agreement with Bank of America. The main point of this amendment was to allow the company to take on this new debt, these senior notes, without violating the terms of their existing credit lines. This is also very common when companies seek new forms of financing. The deal itself was put together through an underwriting agreement. This is where investment banks, in this case BofA Securities, Wells Fargo Securities, and Raymond James, help the company sell these notes to investors. They essentially buy the notes from the company and then resell them to the public. The company entered into this agreement on June 9th, and the sale closed on June 12th. So the whole process from agreement to closing happened very quickly in June 2026. This offering was made under a shelf registration statement. This means the company had already filed with the Securities and Exchange Commission, or SEC, general plan to issue securities over a period of time. Then, when they wanted to issue these specific notes, they just filed a prospectus supplement, which is a shorter document detailing this particular offering. The registration number here is 333-295812, and the prospectus was dated May 12th, 2026. All these important documents, like the underwriting agreement and the supplemental indenture, are attached as exhibits to this filing for anyone who wants to read the full legal text. Now, let's think about what this means for Mercury General. They've just taken on a significant amount of new long-term debt. On one hand, this provides them with capital possibly for growth, acquisitions, or to refinance existing debt. On the other hand, it increases their overall leverage and their fixed interest payments for investors. It is crucial to understand that this 6.250% interest rate is a new fixed cost for the company. Given the current interest rate environment, this rate seems competitive, but it is still a substantial commitment. Mercury General is in the property and casualty insurance business, a sector that can be sensitive to economic cycles and interest rate changes. Raising debt like this is how insurance companies often fund their operations and manage risk, but it is always a balancing act. Looking at the context, Mercury General stock has seen a significant surge over the past year, and the company also recently announced strong first quarter profits. This debt issuance could be seen as a strategic move to capitalize on favorable market conditions or to fund future expansion, especially as they seem to be outperforming in their latest earnings reports. The key risk here is ensuring that the company's operations generate enough cash flow to comfortably service this new debt, especially if we see an economic downturn or a significant increase in insurance claims. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.